The official inflation rate is 3.8%. Your car insurance is up 64%. Your ACA premium is up 26%. Pick one. All of those numbers are real. They come from the same data ecosystem, both measured by the Bureau of Labor Statistics. Both accurate and completely incompatible with each other, unless you understand exactly how the 3.8% gets built. That official number, the one the Federal Reserve sets interest rate policy off of, the one Social Security uses to calculate your annual raise, the one your employer used to justify whatever raise you got or didn't get last year, is not even being measured the same way it used to be. The inflation rate stopped being properly measured last year. We will get to that. But first, the methodology. The one that produces a 3.8% headline while your grocery receipt reads like a formal disclosure document. Let's be fair to the number. The all-items CPI for April 2026 is up 3.8% over the previous 12 months. Core inflation, which strips out food and energy, sits at 2.8%, above the Fed's 2% target but not catastrophic by historical standards. The BLS constructs the CPI by gathering a basket of goods and services, weighting each item by what consumers actually spend on it, and tracking how those prices move. This is the number the Fed uses to set interest rates, the number Social Security uses for cost of living adjustments for 70 million beneficiaries. The CPI is not a vibe, it is a policy instrument, and by that instrument's reading, inflation is mostly contained. Technically, that is the operative word, because inside that 3.8% headline, beef prices rose 14.8% year over year. Airline fares rose 20.7%. Gasoline increased 28.4%. None of those numbers is 3.8, and wages are not keeping up. Real average hourly earnings fell 0.5% for the month and declined 0.3% annually. Workers are collecting more nominal dollars and quietly falling behind in real ones. So the question is, how? How does a 3.8% headline contain 14.8% beef, 28.4% gasoline, 64% car insurance, and still read 3.8? The answer is that the headline is the average of a basket, and almost nobody buys the basket. Most people buy a small handful of things, and in 2026, those things are almost universally outpacing the average. 4 forces drive that gap, and one of them is the strangest of all. Force 1, the basket does not describe you. The CPI is a weighted average. Shelter accounts for roughly a third of the entire index. But for the average renter in San Francisco, shelter is not a third of the budget. It is half or more. The basket assumes the average household. Technically accurate. Practically, it describes nobody. For owner-occupied housing, the BLS does not measure what it actually costs to own a home. It uses what it calls owner's equivalent rent, what homeowners estimate their home would rent for on the open market. About 77% of California homeowners hold mortgage rates below 5%, locked in before 2022. New buyers today face around 6.25%. Those two populations live in completely different cost realities. The CPI draws from both and produces one number. The BLS also accounts for substitution. If steak gets expensive, it assumes some consumers switch to chicken. Reasonable for some categories, but there is no chicken version of health insurance. No cheaper substitute for daycare. For the categories that dominate real household budgets, the substitution assumption describes a consumer who does not exist. Force 2. The categories you cannot escape are the ones moving fastest. Health insurance. ACA marketplace premiums are up an average of 26% in 2026. The Century Foundation's assessment: no historical precedent for such a significant increase for this many Americans. Family employer-sponsored coverage averaged $26,993 per year in the 2025 KFF survey, with 2026 projections approaching $29,000. Childcare. The federal affordability benchmark says no household should spend more than 7% of income on childcare. The latest data shows the average parent spending 20% or more, missing the threshold by a factor of 3. Car insurance. Auto premiums rose more than 64% between 2020 and 2025. General inflation over that same period was 25%. Car insurance ran at more than 2.5 times the official rate, using the BLS's own underlying data. And the Medicare math is almost elegant in how blunt it is. The annual increase in Medicare Part B premiums in 2026 is $214.80. That exceeds the estimated annual increase in rent, $203, and food, $144. Retirees received a cost of living adjustment that was quietly consumed by their Medicare premium before they ever saw a dollar of it. Force 3. The inflation you cannot see at all. Shrinkflation. The GAO formally documented this in July 2025. Prices unchanged. Contents reduced. Skimpflation. Same price, worse product. Less cheese. Cheaper ingredients substituted without announcement. You pay the same and receive something technically in the same category, but practically worse. Junk fees. The American Economic Liberties Project estimates junk fees cost the average American family more than $3,000 per year. Consumer Affairs data shows 85% of Americans have encountered a hidden or unexpected fee in the previous 2 years. The price of the cereal did not go up. The amount of cereal went down. The BLS picks up the first one. It only sort of picks up the second. Force 4, the strangest one. The inflation rate stopped being properly measured. During the 2025 federal government shutdown, the Bureau of Labor Statistics lost the ability to collect rent and owner's equivalent rent data for October 2025. The agency published the October CPY using imputation methods. In plain English, the rent index was substantially carried forward from September's figures because the underlying data did not exist. The BLS was transparent about the gap. It was still a gap. Strip out energy and core still ticks to 2.8, with shelter, airfare, and apparel all accelerating. The underlying pressures were already building before the external shock landed. The official number is 3.8%. Moody's says late 2025 should have read closer to 4.1. The number you actually experienced, factoring in the categories the basket undercounts, the products getting quietly smaller, and the housing you cannot actually afford to buy, is probably higher still. The official inflation rate is an average of a weighted basket that assumes substitution, adjusts for quality, undercounts the categories you cannot escape, and last year stopped being properly measured for several months. So when it feels like your insurance, your rent, your daycare, your groceries, and your subscriptions are all somehow outpacing inflation at the same time, you're not crazy. They probably are. And the way the number is built means your real cost of living is almost certainly rising faster than 3.8% suggests. Watch this next to find out why your wages probably are not going up as much as you think, even when you get a raise. And don't forget to like and subscribe.